Our stocks continued a very predictable pattern here. We're moving up by just a few points here or there on the big indexes, on the large cap indexes. We're moving up very small ranges, very small volumes, low volatility. And it's just a nice grind to the upside that we're not seeing in anything that doesn't have the exposure to all of the Magnificent Seven, or in the case of the Dow, which only has the two. Apple and Microsoft, or in the case of the Russell, doesn't have any exposure to the Magnificent Seven, at least directly to those. So very different performances we're seeing there. So we'll break down that difference. It's actually showing up on some very rare patterns. I'm going to show that to you today in today's video as well. From a long-term perspective, we've seen these patterns before, and they've had, as rare as they've been, we've seen them before. In the case of the Russell. And we've seen there's an analog to what we're seeing right now, and I'm going to break that down when we start breaking down the what's driving the markets today. So interesting things developing here inside of this very complacent, very predictable, very tame market that we've had, setting ourselves up for a not so tame move, not necessarily to the downside, but a bigger move that's setting up right now. And I'll show you why and what we're seeing. And then we'll take a look at our trade idea, a stock that has been in a death cross, definitely in a bearish trend, but appears to be reversing that trend with a good bullish move here, finally kind of catching up to what the market's been doing. So we'll talk about how to trade that. So let's go ahead and get started. Today is Tuesday, July 9th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom. This is where I take a look at old trades, whether we should stay in them or not. We also put on today's trade that you'll hear at the end of the video already before the market closed today. We did that during this particular class. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click that thumbs up icon. It opens up this tab. I don't know why it's not there. But it should help, you can be able to like that there as well. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks and help us get to our goal of 100 likes on our Market Outlook tweet. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see the S&P closed higher today by just over 4 points, but it's the sixth close in a row. 9 out of the last 10 days have been to the upside, with only one down day there stuck in the middle, with one cluster in the last 10 days as well. So pretty good moves. So you can see only just a few down days since we bottomed out here in the end of May. So since from the beginning of June, it's been a good run. But especially the last 2 weeks, we are more than 2.5% above the 30-day moving average, so we're continuing the trend. That's a kind of a level you need to be at to continue that trend there. The near-term line still in the reversal zone, so very good sign there. And the intermediate line strongly bullish, market sentiment strongly bullish. You got three of your longer-term lines, all three above the 80th percentile. Very good, good move there. The momentum line is dipped down the bearish territory, mainly because of the smaller ranges today. We had like the ranges there right before the holiday. We had a 51-point range. Remember, the average is like in the low 40s, so a 51-point range, then a 31-point range, a 38-point range the day after. So this was a 31-point range in a half day of trading, a 38-point range on a full day of trading, and then you have a 20-point range and now a 16-point range. So we're really dropping pretty sharply. And that's what that's mainly the reason why the momentum line is dropping. We've been up all 3 days, but small ranges have brought that down to oversold levels. So technically, this is a bullish intermediate confirmation signal. Now, again, you would expect the momentum line to bounce out of this like it typically does when you're bullish. You come right out of the reversal zone. The question will be whether how far the near-term line falls, because remember the near-term line is still. But again, you can see you didn't quite get the bearish territory there on the momentum line, or at least oversold levels. But you got in the bearish territory and it bounced without the near-term line dropping. Same thing here. The near-term line was out of the upper reversal zone, but still in bullish territory, and it bounced still. Then same thing here, and it bounced still. And then it finally got the bullish intermediate confirmation signal with the near-term line in the reversal zone. So it can bounce and maintain. We've had some pretty good long runs on the near-term line from being at bearish levels to staying at bullish levels. A couple of really good long runs here. You can see like the last bullish cycle, we didn't have so many long runs. It got really short and choppy by the end, and then ultimately forming the bearish peak that, again, we were very wary of. But as of right now, again, there's a good chance that we bounce right back up off of this. Now, how much higher we'll go? Like we didn't go very much higher on these bounces. We did get that move up to that cluster there, but we didn't go very much higher. So I don't expect that we'll go very much higher here. I mean, shoot, we're up 4 points. We were up 5 points yesterday. We're up 4 points today, and the market's talking to everybody on TV is talking about how bullish the markets are. So but we're only up 9 points in the last 2 days on an index that has a 40-point range. So, but we're going up. But that's the most important thing, is we are still moving higher. And so I expect we'll probably end up with a small gain through here, the middle of the week, before finishing the week on a high note as the momentum line bounces back out. That's the S&P 500, and of course it looks very similar to your NASDAQ. The NASDAQ, same thing, momentum line dipping down because of the smaller ranges, 148 points. You can see in the blue box up at the top middle versus the average range that's over 200. We are 5% above the moving average, which is the 89th percentile there, so a little bit lower. But again, the momentum line dropping down to oversold levels. Near-term line still in the upper reversal zone. So we should bounce, but probably won't bounce very much, like we've seen in the past. That's not the case for the Dow and the Russell. The Dow and the Russell continue to show relative weakness, right? The intermediate line is rising, but the near-term line is crossed below it. So now it's in bearish territory, and it has not dropped into the lower reversal zone. So that's a good sign, right? The last couple near-term peaks here have been, relatively bullish, right? These have been bullish lows, relatively bullish lows. And there's a good chance that this ends up being a bullish low point, right? Remember, has to jump out of that level, and we did drop from being in bullish levels, not quite being above the 80th percentile, but being in bullish levels. We have dropped now 1-2 days without getting below the 20th percentile. So there's a good chance that it ends up being a bullish peak, and then again, it's going to be a matter of how long it takes to get back above the 80th percentile for us to get a good bounce up to the upside. But as of right now, the near-term line, the intermediate line is above market sentiment. They're both rising, so that's good. There is a little bit of a dip here, but if we do get that bullish intermediate confirmation signal on the S&P and the NASDAQ to bounce up, ideally the Dow to bounce up off of this too, you can kind of see the picture for a near-term, a very short-term bounce here really soon, tomorrow, Thursday. Little different picture on the Russell. The Russell 2000 can't quite get going. So again, here's 2 days from being below 40 in the near-term line. 2 days later, we're not even above 50. The Russell 2000 was down 0.5% today. You have light green shading. The intermediate line has turned higher, but you're back to a red line because you're back below the falling moving average. The intermediate line remains in bearish territory, remains below market sentiment. So you technically can call this an intermediate confirmation signal because there is a bullish posture. It's weak, it's green, so hence bullish, but it's light green, so it's weak. So it's not the greatest intermediate confirmation signal, but it's better when your intermediate line's up in the upper reversal zone and then your momentum line's in the opposite reversal zone. That's technically the signal. But by definition, you have a bullish intermediate confirmation signal. It's very, very weak. And your near-term line, like I said, is above the intermediate line, but it's not even in the upper half of the chart. So again, likely not to form a bullish near-term peak because we're already 2 days and we're not even in the upper half of the chart. So, good chance that this kind of bear tag signal that has developed, you don't see it because it's not exactly a bear tag. The light green shading and the yellow line need to be in the same day, and they're separated by a day. But it's the same idea, and likely that pretty much produces a bounce down from this, and we'll see if what wins out, the intermediate confirmation signal on these large cap stocks, mega cap names in the Nasdaq and the S&P, or the more broader bearish trend that we're seeing. And remember, the S&P, when you look at its equal weighted index here, it looks very much like the Russell 2000. It's got a bearish posture. The intermediate line is rising above the 20th percentile, so you got light green shading. But your near-term line, it looks like it's forming a bearish peak, and we're the intermediate line's below market sentiment. So it's there's not a whole lot of bullish patterns going on the equal weighted S&P 500. So as we all know, it's the handful of companies that are doing so well. In fact, I tweeted out here earlier. If you follow me on Twitter, let me post this, bring this over here. Give me 1 second to do that. Where is it? Right here. So I'll right click and bring this over so you can see it. So here is the 10-week correlation between the S&P 500 in purple, the SPY, and then the RSP, the equal weighted index. And you can see we have a negative correlation. I think it ended up at a negative 72% today. But a negative correlation over the past 10 weeks, which, as you can see, is unbelievably abnormal for the equal weighted index in the S&P. And then, of course, here's your Dow Jones Industrial Average and its correlation. You can see we did have a negative correlation briefly, and at the end of 2000, of course, we know what ended up happening. It's not common, nor is it good for the Dow Jones to not be positively correlated to a large degree with the S&P 500. All right, now let's take a look at the weekly chart that we have here. The weekly chart, you can see we're continuing to get a very strong weekly candle. Again, a higher high, a higher Hakinyashu close. We're in the 95th percentile of this past 3 years in terms of how big the gap is between the 10 and 40 week moving average. If I expand that out to 5 years, we're at the 88th, so not quite in the 90s yet, but still pretty darn high, still pretty bullish. The candle sizes are not very big, but again, they generally are the biggest early in the bullish stage, and so here's the peak, and now we just kind of converge, and that's what we're doing. And as long as we're at least above the purple line, the size of the candle is big enough, right? Big enough to continue. And like I said, also if we're getting higher highs and higher Hakinyashu closes, that's big enough. That's all we really need to see. And that's fortunately what we are seeing. 3 green arrows on the S&P and the Nasdaq, not anymore on the Dow because we have the red arrow on the stochastics, and then not anymore on IWM either because we have the red arrow back on the moving average. So, again, you can see, and if you look at RSP, we actually have had 3 red arrows on the equal weighted S&P, and we're not 3 reds now because of a slight turn up higher on the stochastics, but we're still kind of in 3 red arrow mode. Potentially 2 greens, as yet stochastics is pretty close, but not quite to the 3 greens yet that the market cap weighted version is easily at. All right, if we take a look now at some of these other oscillators, you can see we talked about the DMI negative indicator still below 10. That's very extreme. Your ADX now is up to 38. It's moving higher. It's not, it can go higher than the positive. It generally doesn't go too much higher than the positive, but it can. You can see by the time we got to this level, it did exceed. In fact, it got to 40, above 40, even though the positive index hadn't gotten above 40 yet. So that can happen. It's not very common, but it can happen, especially because the negative indicator is so low. Generally, when the negative indicator is this low, the positive is usually a lot higher than this. So that's the biggest reason why. That's the biggest reason why the negative, the ADX, is rising so much, and it looks like it might have already. Yeah, it looks like it's barely already outpaced the positive directional movement index. Of course, IWM is a different story. It is, both lines are above 25 now that the negative is up there. So your ADX is extremely low. Again, I've told my class today that the Russell 2000 is really setting up for a big time squeeze play, which is a big breakout. One way or the other, there's a big breakout just waiting to happen on the Russell 2000. If you look you'll see that in the Bollinger Bands here in a second. If you look at the Russell, the S&P, again, very high RSI, very high CCI, so very big moves. Again, it's one thing to get that move above 200 early on in a bullish cycle, like we did right here. You got close. But once you start to get it late in a cycle, that generally, like early on is great. Late, not so great, right? So we'll see how that ends up playing out, especially with such an extreme on the RSI. That tends to, you tend to kind of get these blow-off type moves late in the cycle, like you see right here in that bullish cycle, like you saw over here in 2021 when we were late, when we got up to positive 150. Like you had this big long bullish run here, and you had that that big spike late in that cycle. And same thing kind of right here too, late in that cycle. So you wonder if that will end up being the case again, if we end up getting this big extreme move late in this RSI cycle, with not only an extreme on the RSI but an extreme on the CCI as well. Looking at the Ichimoku cloud, obviously you still have a mature trend on the S&P. The Russell, this literally has no trend. I mean, both lines usually hit zero. Both lines have hit zero now, today, but they usually hit zero after you've had like a big move, right? So you've had a big move, they both hit zero, like on this day. It kind of changes the trend. It's not very common for it to hit zero when you haven't had a trend. And it's done it 2 days in a row now. So 2 days in a row we've been at zero, which again goes to show just how trendless the Russell 2000 is. And then as you can see here with its Bollinger Bandwidth at extreme lows, setting up for again, and how far inside the Keltner channels we are totally setting ourselves up for a tremendous squeeze play, a breakout of potentially biblical proportions. Ideally to the upside, but we don't know, right? You would, again, that would be the expectation that you hear a lot, that we're going to get this broadening out move, that the Russell 2000 will take off and start playing catch up, right? It could catch up to where the S&P is, and I think that's the hope that we all have. But we do need to be aware of potential breakdown to the downside, especially considering again that negative correlation. As that's another thing I shared on Twitter. Let me bring this back up here. One of the other posts I tweeted out was the negative correlation between the S&P 500 and the Russell 2000. So this one. So this is the fifth time since early 2000 that in the history of these two ETFs, IWM and SPY, this is the fifth time that we've had a negative correlation. By far the biggest negative correlation over 10 weeks. But you can see by my orange arrows what the Russell 2000 has done after we have these negative correlations, right? So again, which way is it going to break out? Now in 2021, it did break out to the upside. It ended up being a very significant fake out, right? Where we broke out and then broke back down and broke down hard in 2022. So that's a possibility too. Are we going to get a fake out? So once we get the breakout, it's got to hold, not break back down immediately like 2021 did. So that's kind of something to keep an eye on. Watch for that initial break and see if there's a knee-jerk move to where it ends up being a fake out. And fake outs end up being a lot, in this case, a fake out to the upside ends up being a lot more bearish if had we just broken out in the first place to the downside, because you sucker in a lot of people thinking that we are breaking out to the upside. You pour in a lot of money, and now they end up on the wrong side of the trade. More than what you had originally when you were so flat, when you're not getting in. But you break out to the upside, you pull in a lot of money, and then you fake out. It ends up being a lot more bearish because you have a lot of weak hands in on that trade. Remember, this is at the end of a really good bullish move, similar to what we're seeing now. Of course, not as bullish on the Russell, but more bullish in the NASDAQ and the S&P 500 over the past, year plus or so since that March 2023 low point. All right, now let's take a look at what's going on with the ranges and volatility, right? So we like to look at the 4-week range here. Getting a higher high, higher low, but look how small. And we closed below yesterday's high. Look how small that range was. The 4-week range is, again, like I said, going to really start tightening up in a couple of days here unless we get significant new highs. IWM, I told you before that the both lines are below 30. That's very significantly neutral. Like, it's very tight. Again, setting up a significant squeeze play. And it doesn't look like we're going to new high or new low tomorrow. Or so, I mean, both these lines can not only get below 30, which is very rare in and of itself, they might end up both below 10 by the time it's all said and done, because they're right next to each other, right? The high and the low are separated by only 3 days. And you've got 2 more days of that high. And then after that, the high really moves up significantly. If we don't get a new high point later above this one, that high is going to drop, and then once the low comes off, the low is not going to rise very much. But still, the range is so extremely low already as it is. Once that high drops, it's going to get even more extreme. And once the low rises, it's going to get even more extreme. So very rare for that to happen, and it could get worse unless we get a breakout in the next day or two. If you look at the ranges, I mean, today's volume and range were extremely light. On the S&P 500, look at that, 27 million shares trading hands. I told you 1.66 points. If you look at the ATR relative, like, we are down now to 0.72. I mean, way extreme on the range, way extreme on the range there. The volume itself is already abnormally low. It's continuing to be abnormally low. IWM looks very similar, right? The range is extremely low. If I were to zoom out so you can see some perspective on where this range is right here in the last 5 years. Again, 2021, very similar, but it goes back to pre-COVID, where we had probably the biggest squeeze play of all. Now, granted, economic shutdown, but one of the biggest squeeze plays there of all, and you can see the volume has really come off in the past, 4 months, as the average volume has dropped off a absolute cliff there. And then finally looking at the VIX, again showing just how extremely low. Again, still above the 85th percent mark here relative to the 3-month VIX, but the VVIX still below 80. The VIX still down at low levels at 12.5. So we're just not getting much movement in volatility or ranges or volumes, and you know, we're getting to the point where this complacency is reaching extremes, this absolute extremes. Doesn't mean we have to drop, but it does mean that we're probably set up for a big move to develop and occur. And I think, like I said, we're all hoping that it continues the move that we've already had. It continues and moves up to the upside. But we do need to be aware of that possibility of that negative correlation between the Russell and the S&P producing a big move in the direction that we've already seen all of the other instances that we've had that particular scenario. All right, now let's take a look at what's driving this price action. So let's pull up the asset class comparison chart here, and let's look at it for today. As we all know, the Qs are the biggest driver right now by far. Nothing else is, I mean, EEM to a small degree is also doing pretty well. But if we look at just today alone, that wasn't necessarily the case. EEM was your biggest mover, but again, very small move. You have to put in context this range. Like, it didn't even go up 0.5%. Everything else really tight, including the S&P and the Qs. IWM was about as big of a move to the downside, and same with developed markets that EEM was to the upside. Bonds dropping, which again has the impact of having higher yields, and then finally commodities really dropping, continuing, right? That was a big drop yesterday. When you look at commodity prices, we had a big drop yesterday, and that continues the case here. Another big drop here today. There we go. So another big drop, but again, not trend changing yet, right? If we were to get below the 200-day, but you see we're just kind of hovering. In the last few expiration cycles, we're just kind of hovering around the 200-day moving average, plus or minus a little bit to the upside and a little bit to the downside. And right now it looks like we're cycling down to just a little bit below with the MACD and stochastics rolling over. And the same thing with bonds. Bonds had a relatively down day today, but again, nothing significant. It's very small compared to the 4-day rally we had that preceded this move. In fact, your MACD, your stochastic is actually still bullish, at least above its moving average, still in bearish, still just barely outside of bearish territory in the lower half of the chart. The MACD is actually still in bearish territory itself and still below its moving average. So I wouldn't necessarily say that the bearishness, despite that 4-day rally, the oscillators don't necessarily say that the bearishness is over with. And we'll see how that implies. Remember, that 10-year yield is really, I mean, this is the long-term, the 30,000 feet view of the 10-year yield. And remember, when the 10-year yield drops, that's not a good sign, right? So when you got pink shading and like the red line, like we did here in 2000 during the bear market, 2010, the middle of the year there, when we had that correction level pullback on the S&P, the correction 2011, the correction of 15 and 16 that was part of this big global slowdown that went pretty much from the time that they started tapering QE3 to all the way to those clusters that we had right before the election of 2016. And then, of course, the 18-19 the global slowdown that led into the COVID drop. Again, like the S&P did great because of the mega caps, but the Russell didn't do too good there, and the international stocks did horrible. So there was kind of a bear market there that we just didn't experience thanks to, back then, the FANG stocks, and now, of course, the megas. But you can see from a big picture standpoint, the 10-year yield is kind of slowing down. And I know that the idea is we want to cut rates, but the reality is the short term doesn't matter as much as the 10-year yield matters. And if the 10-year yield were to really start breaking down hard and getting dark pink shading and a red line on its weekly market forecast, so let's zoom in so we can see this a little bit better on the weekly market forecast. But if we start to break down here, the intermediate line is already below its market sentiment, and kind of forming a bearish peak and breaking down. If we start to break down hard, then I don't think there will be enough rate cuts. Like, we can't cut fast enough to catch down, right? Because we're already down. Like, remember, the Fed funds is up like 5.25, so you're already 100 basis points above your spread between. Let's see here. The spread between the 3-month is kind of your effective Fed funds rate. So the spread between your 10-year and the 3-month is still at over 100 basis points here. So like, if the 10-year doesn't change, we have to have 4 cuts just to catch the Fed funds rate back down to be normal on that curve. Of course, if we were to do 4 rate cuts, the 10-year is not going to stay flat. It's going to go down too. So I don't know if we can cut fast enough to catch down to where the 10-year yield is. And so I don't necessarily think. I think what we all really would prefer is the Fed doesn't cut rates and the 10-year yield rallies back up to its normal levels, closer to where that 3-month is. That is our ideal scenario. That's actually what's been bullish the last couple of years, is when the Fed has not cut rates. But it appears that they are more likely to actually go through with it this time. In September, you can see the odds are at 26% there. Still 1 in 4 chance that they don't cut, 3 in 4 chance that they will. But if they actually do go into that and like I said, start a cycle of cuts, then that might say something more about the kind of economic environment we're in than what we really want it to be. So we don't want TLT, we don't want 10-year yield to really start breaking down hard. We don't want TLT to really start breaking up to the upside and filling in this gap, because again, the more bullish it is, that's generally, bonds are typically strongly bullish when we're in a period of risk aversion, not necessarily risk appetite. I know hasn't been the case in 2022 when there's been a positive correlation between bonds and stocks, but that is an abnormal. That's your inflationary period when TLT and SPY are typically positively correlated with each other. If I were to go to a 3-month correlation here between let's just go apples to apples here with ETFs on SPY and TLT. I'm going to go SPY here as well. Okay, and then let's zoom out so you can see the long-term view. Again, it's normal for it to be negatively correlated. And it's very rarely that it's positively correlated at 80% clip or higher. And you notice when it has been quite a bit here recently because of this inflationary period we've been in, it doesn't stay there, right? So if the ratio starts to drop and goes back to its normal negative correlation, then that means these are moving in opposite directions. Which way is it going to be? Is it going to be down on bonds, which is already extremely low, and then up on stocks, which is what we all would hope it would be, or is it going to be the other way around, which is probably the more likely scenario? That's the concern, right? If demand for bonds really takes off, we get back above 100 on TLT, and this ratio drops back to its normal levels, that won't necessarily mean that stocks are still rising, because we won't be in that same inflationary mode anymore. We'll be back to our normal mode of being where rates are falling, right? Where that 10-year yield is breaking down, and we're in a falling rates environment instead of a rising rate environment. Let's take a look at the sector moves. So let's pull up the sector chart here. Again, XLK really dominating over the last 3 months. XLC and XLY doing pretty good too. Financials, which got a lot of play today and have not been doing very well. So it's kind of interesting that everybody was talking about how great financials are because they had a good day. They had a good day today, but it's like just because they have one good day, they've been underperforming the market all year long, and they've really been underperforming a lot of the sectors of the market in the past 3 months. So don't get too wrapped up about one day, especially when the economic growth sensitive areas continue to really lag. Industrials, energy, materials, these are the sectors that represent a growing economy, and they're not representing a growing economy very well. They continue to lag, and from a relative strength standpoint, they are now moving. They were moving in the right direction just a few days ago. They are definitely now moving in the wrong direction. You can see industrials back into lagging. Energy is dropping hard. Materials is back into lagging. Healthcare is back into lagging. Staples. Financials is moving down. The only thing moving up again is just technology. Even though you have XLK and XLY, despite losing momentum, at least still has positive relative strength. So you're still, those are the three big winners. As long as the markets are bullish, these are the three areas. As much as people like to talk about, because they don't want to tell you to chase those big returns, but in the market cap weighted where we're 30 some odd percent in the top 10 stocks, that's the kind of market we're in. Until the music stops, you have to keep dancing to the music. You can't keep saying, oh, I know that we've been dancing to this rock and roll music for a good chunk of the night, but I think that we should really start doing some country dancing here. No, you keep dancing to the same music until the music stops. And that's these three sectors, and especially XLK, as you can see again, the only one gaining some momentum right now. Again, until the music stops, which when you look at the Economic Surprise Index, suggests that the music's not very far away from stopping, especially when combined with how extremely high the valuations are, right? Your 10-year valuations above 36, has been above 36.5 here recently, like very, very strong valuations combined with a deteriorating economic situation, very similar to 2021. Remember, you've got strong valuations. You've got an economic surprise index that you can see down to pretty strong negative levels, and you have the Russell 2000 negatively correlated with the S&P, and setting up for a very strong squeeze play, very similar to the end of 2021, where again we had the fake out to the upside, and then 2022 happened. So that's what we want to avoid. But we do need to be aware of that analog and that situation, because it appears we're just doing the same thing all over again. All right, let's take a look now at our trade idea of the day, and our trade is on Roku and that discretionary space or communication services space, up 3.5% today. Good day. It's had a good couple of weeks here, coming off of These cluster lows from mid-June, as you can see at 52.5 are up to 63 now, but really from this June 26th move up, it's done really well. It's brought the intermediate line, good strong move on the near-term line. It's brought the intermediate line, the upper reversal zone, big jump in the momentum line today, suggesting a very high probability the near-term line makes its way into the upper reversal zone tomorrow to follow the momentum line up there. So good move higher for the Roku. It doesn't look too great here on this weekly chart because you're still in a death cross environment and the candles are not that big. You can see we had that big candle there. You're already flirting with getting below the average. The PPO was rising, but it's still at pretty strong negative levels. And again, smaller candle. We don't even get a higher high yet this week. So it's not the most bullish pattern there on a weekly basis. You do have the 3 green arrows, obviously, on its chart. The MACD, the 8 and 17 day moving averages have crossed above the 30. So that's all positive. There we go, finally. And that's all positive there. But you are running into the point of control over the past year. So the very significant resistance level that you have to break through just to get to continue to fill in this gap up to the 200. You have earnings coming out here soon after the expiration of July. The MACD and stochastics obviously at bullish levels. You have some pretty decently bullish, but not strongly bullish patterns on these oscillators. Like, we had a good bullish pattern there. The ADX is rising. It's not above 25 yet, but your positive has already started dropping pretty sharply. That's not the best sign from a long-term bullish standpoint. The RSI and the CCI are, bullish levels on the RSI, but not so bullish levels on the CCI. You're already back down below 100. So it's not the greatest move there. When you look at the Ichimoku cloud, we are slightly above the cloud, though we're still pink going forward here. But we do have a bullish trend, but it's very weak. So nothing really developed there yet. And we're not really breaking out of either the Bollinger Bands or the Keltner channels. We're still, we're kind of right on the upper Keltner channel, but still below, barely into the upper quartile of this bandwidth that's really increasing here with some positive momentum. Relatively weak positive momentum. So it's a great bullish trade, but it doesn't look like it's got the, the best bullish pattern yet. So what I decided to do here was say, okay, let's take a look at the options, and that's, with earnings coming up, mind you, before August expiration, let's sell those low 20 deltas on both sides. Buy one strike away. It's a $5 wide spread. Buy one strike away. So that gives me this spread here. And you saw where my break-evens were. So my break-even is the new lows, new 52-week lows to the downside. So obviously that would be, we don't want to be an iron condor anymore for breaking that low point. And we got plenty of room if those earnings blow out to the upside and we continue to push higher. So lots of room up there. And of course, if it breaks out there, we want to be bullish there too. So I like this setup here, and again, less than normal risk because of the earnings to get a normal reward, which is actually a little bit above normal reward. So I like that setup, and that's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.